Hi, everyone. Welcome to another week where we are calling all investors. We're live with Caeli Ridge. We meet every Tuesday here at 4:30 p.m. Eastern, 1:30 p.m. Pacific to talk about all things investor real estate. Caeli's dressed up because she's going out to her annual awards event afterwards. For those that don't know, this year she's honored with the Best Hair Award for Tuesday, March 21st, 2023. And there you go. That's the award she's going for. So we're gonna talk. I think for those that don't know, Caeli and I talk pretty much every day, and we try to figure out what we can do to help folks through. And one of the biggest things that comes up over and over again is what's holding you back? What's your biggest fear? So we're going to have this as an open Q&A today, Caeli. We're going to get people talking about what's holding them back, what's their open fear, and then as in the middle there, once we get through that topic, we're going to also see if there are any meeting notes from the Federal Reserve meeting today, if there's any meeting notes released, and we're going to talk about those. As always, this is a collaborative conversation for everybody here. So please make sure that you're either using the chat function here in Zoom or you're using the question and answer tool. If you feel like you'd rather ask the question and you want to take yourself off mute, go ahead and raise your hand, and we'll go ahead and make sure that you are letting us know that you want to ask a question directly to the group. And with that, Caeli, Best Hair Award for today, Tuesday.
Thank you, Larry. He's jealous, right? It's all about jealousy, right? You can see that's the reason. Yes, I just got my hair cut, and I fully anticipate winning the award that I'm going to be going for after this. Hi guys, we're back in meeting mode. I'm excited. So our participants are a little light right now. I don't know, for those of you that weren't here, there was another issue with Zoom in registration. So for anybody watching this after the fact, we apologize for that. We'll get it all worked out. You'll be able to see it as soon as we have this up on our community. So we'll look for you there. But today, as Larry said, pain points, right? What is keeping you from moving forward in real estate investing? What are your fears? What are your concerns? So anybody that has anything, please chime in. I have probably a good feel for what those comments are going to be. I talk about them all day long. More often than not, in today's environment, we're talking about interest rates and or cash flow, or lack thereof cash flow. So guys, start putting in your chats or asking to be taken off of mute, and we can talk directly. But if those two primary things come up, or that's the top of mind for you, what I would say in my response to my clients when we're having these discussions is you need to be diversifying and looking at all forms of real estate investing, not just a single family long-term rental. Maybe it's time to start looking at a 2 to 4 unit in a mid or short-term rental space. And someone would say, what, a fourplex for a mid or short-term? Actually, something of interest that I think is quite ingenious. The trick is going to be to find it, but maybe finding a property that can accommodate a variety of objectives. We've talked about this here in the community before, where if you find a 2 to 4 unit property, perhaps if your concern is high rates, cash flows aren't what they used to be, which, by the way, guys, as investors, you know, if you've been doing this long enough, you tend to recognize that it's not a straight line. It doesn't just start in one direction and stay there. This is an investment. As all investments are going to be cyclical, nothing is more true than when related to real estate. It is a cyclical investment class, right? It goes up and down. You've been around as long as I have. You've seen a few of these cycles. The cash flows that we saw from 2020, 2021, and 2022, those are not the same as they're going to be today. Interest rates are higher. Price points, they're coming back down, so that's going to soften the blow a little bit. But you need to rejigger your expectation. All right, if you're in real estate with the expectation of getting cash flow that you got in 2021, and that's the only way that you're going to invest, well, then you're probably not going to be investing. And I think that you're going to be selling yourself short. We can get into some of those details later, but back to my point. So if cash flow is less than what you're expecting, then let's open up the broader vantage point or lens of what options you have. It doesn't just have to be a single family residence for $120,000 in Indiana. that's cash flowing $350 a month, maybe we need to look at some kind of hybrid. So to my point, 2 to 4 unit property, let's just call it a fourplex, okay? In a market that has some good cash flow, good strong cash flow. Ideally, you want it to be in a market that also can perform for some longer term appreciation. But what if you took this 4 unit property and you made one of the units a long term, 2 of the units a midterm, and 1 of the units a short term, okay? Or whatever combination thereof based on your risk tolerance or aversion. That would be a way in which you could mitigate one of those concerns or fears. Now, I think I said this already, the trick is going to be to find this property, right? You're going to have to do some extra digging. Or what if we just do one long-term over here and a short-term over here, and we can kind of offset? Because you're going to have more cash flow on a short-term, potentially a midterm. You're going to have more cash flow on a 2 to 4 unit than you will on a single family. But the balance of those things should, if you're looking in the right places, should dispel any of the concerns having to do with reduction in cash flow and increase in interest rates. Do we have any questions yet, Lair?
We do. So Shantasha asks if you could really speak to understanding cash flow and a higher education on financing options. Those are 2 things that Shantasha wants to talk about.
Okay, understanding cash flow. From what perspective, I don't know exactly, Shantasha, so feel free to take yourself off mute if I'm going in the wrong direction. But cash flow is as a means of identifying what your rate of return, your cash flow. Let's bring it back to just a real granular level. You have your gross rents, right? What you're going to rent the property for. You have a tenant in there, they're paying X in gross rents. And then what do we have for the hard expenses? You've got principal and interest, probably if you have a mortgage. You've got the taxes and insurance, which are absolutely hard. You've got HOA, which is also a hard expense. Then your chances are you're going to have property management, unless you're going to try and self-manage, which if you're new to this, I think it's a great idea to get that education. I think most people that try to go down the property management rabbit hole learn pretty quickly that that's not where they want to be spending their time, but to have the experience, I think, is wise. But it may not necessarily be a hard cost. And then you've got vacancy and maintenance. Those also need to be factored in there. So depending on where the property is, the age of the property management's effective use, all of these things, you're going to take your gross, you're going to take those expenses, and then that's how you're going to come up with your monthly cash flow. The division of costs and expenses. Now it can be the monthly, right? The monthly income versus the debt. We can be looking at your initial capital expenditure, what you're putting into the property versus the annual return for your ROI and things. So I think that's what you're asking. That's really going to be how you break it down on a property per property basis. What was the second part to that, Larry?
Second part was really just understanding what financing options are there. And then I would just, if I could read Shantasha's mind, it would be like, how do I really start to retain? Is there something that would be helpful for me to understand best financing options to get over the fear of investing?
Yeah. So the finance options are plentiful, at least here at Ridge. Most of you know we're not a one size fits all. We have a very diverse menu of loan programs, many of which are geared to a real estate investor. Not all of them, but many of them. So just to quickly go down that list, and then we can dig into some of them a little bit deeper. You've got your conventional Fannie Freddie's, the golden tickets. You've got non-QM. QM stands for qualified mortgage. Fannie Mae and Freddie Mac are the sheer definition of what a qualified mortgage is. This came from Dodd-Frank and the 08-09 housing and lending crash. Was born QM, qualified mortgage, and the ability to repay. That's what Fannie Freddie is. Everything outside of that bucket or that box is now non-QM. Non-QM is not just for investors. It's for anybody that can't fit into the confines of a Govy loan, FHA, VA, USDA, or agency Fannie Freddie. So you've got non-QM over here. This can be for debt service coverage ratio, where you can't show your own income. You really just want the property's income against the mortgage payment to offset. And if it qualifies, then you've got debt service coverage. There's bank statement loans where if you can't show a tax return, but you've got ample deposits in bank statements, 12 months of personal bank statements or business bank statements, whatever, that we can use to show income. That would be another way. You've got asset depletion. Let's say you've got $1 million sitting in your self-directed IRA. We could look at that and come up with a number of income from the asset that can help you qualify on more of a full doc basis, and so on and so forth. So that's non-QM. We have the all-in-one, my favorite. We have commercial products that can effectively work for residential properties. It's called cross-collateralization, where you're taking multiple residential properties, any combination of single family up to 4 units, and putting them into one blanket mortgage, commercial mortgage. On the commercial side, guys, there's recourse and non-recourse. I can touch on that if anybody wants me to. And there's more. We've got foreign national products. I can go on and on. So those are going to be the differences in loan programs. But in terms of feeling secure that you're making the right decision on an investment, especially if you're brand new and really green to this, I think that this is where Ridge is going to shine. So my advice to you would be to apply, get online, or if you haven't gotten the link to apply, ask one of us for that. We'll send you the link. You go online, you submit your online application. It comes into us. We gather your documents, your pay stubs, your W-2s, your tax returns, your mortgage statements, your insurance statements, anything and everything, depending on, what your circumstances are. And then we compile all of that for you, figure out what your baseline qualifications are or exist today. And then we can really get into what does that mean in connection with your goals and what products are available, and put together, I'm always talking about that damn roadmap. You guys have heard me say it 500 times. But plant the seeds and put together the roadmap based on all of those things, and then your propensity for risk aversion or acceptance of risk. And then we can even say, this is the balance of long-term rental versus short-term rental that I think might suit your needs best, or single family versus the 2 to 4. Maybe you're even looking at alternative means of investing in real estate that doesn't include real property. Maybe we're talking about mortgage notes, right? Maybe you're looking at syndications, some other things like that as a nice balanced portfolio. We can kind of get into some of those details too. So hopefully I answered your question. It's probably a little wordy, but what else? Who else has questions for me?
I think the answer was great, and Shantasha, I'm going to be posting the link to apply, and thank you very much for taking that next step. This is something that I think would be, we don't have any other questions, Caeli, but can you speak to, again, a lot of this stuff you roll off your tongue because you've been doing this so long. And I think the fear of not knowing what is out there, maybe holding some folks back. So, you do a lot of certified power buyer interviews, right? And you're helping people get set for that long-term vision. Are there any things in particular that come out in those meetings that you find are generally everybody has, like questions or concerns or recommendations that you're always making?
Yeah, that's a good question. I find very often people are surprised by how much they can qualify, or that they can qualify at all. We'll have clients come in expecting, now I won't be able to qualify right now, but I want Caeli's advice or Ridge's advice to say, these are the steps that I have to take in order to qualify, when it turns out that they can qualify right now today with what they have access to. So a lot of times the idea behind what they think it takes to qualify and what it really takes to qualify aren't the same thing. So it's important to look and to check and to have that conversation. And even if it's not viable today, based on what you've got, whether it's a debt to income ratio issue or an asset issue or a credit issue, at the very least, you're going to walk away with more information that you can start applying to get you to the place where you can qualify. It's very, very rare, you guys. I mean, very rare, where I come across a client that I say, I have no options for you. In fact, I can't even think of the last time that happened, where Mr. Jones and Mrs. Smith came to me and said, I want to get into real estate investing. And I had to come back and say, I have absolutely nothing for you. I don't have any advice for you. You're never going to qualify. That's never happened. So if there's fear about, not being able to qualify, I would stifle that and, apply. Let's actually look at it together and see, what does that mean for you today? More often than not, people are very surprised to learn that the mortgage debt that they're going to be securing, let's say they're going to purchase an investment property, they don't realize that it can more often than not be offset, at the very least, with the rental income that investment is going to yield. Yes, there's a mortgage payment that's going to be a monthly debt, but there's also income. These are rental properties, right? Very often people are surprised to learn that those two things in underwriting will offset, so that if their debt to income ratio was within that 50% threshold to start with, the new acquisition is not going to be a hindrance. It's not going to preclude them from qualifying. That would probably be one of the top things that people get wrong. The other thing is assets. People a lot of times don't know where to look. They have access to assets, whether it be harvesting equity, maybe there's a 401k or a retirement account that they can access. And if nothing else, then we start looking at joint ventures, right? Where they partner up with somebody else that has the money and they've got the time and the qualifications to get it going. There's lots and lots of ways to skin the cat, people.
And of course, that's a figure of speech. Caeli doesn't actually skin cats.
I'm not a cat fan, so if I
Nope.
had to skin a cat to eat.
Okay, so we do have a question from Alexander.
Okay.
So Caeli, here you go. So for a first-time home buyer, when buying a duplex or a triplex or a quadplex, can you use the rental income from the other non-owner occupied units as a first-time buyer?
I love it. Alex, you just illustrated my point 100%. So guys, check this out. So this is a perfect example. Let's say that, let's say assets were your issue and you didn't have 20% down or 25% down to get into a rental property, but you're interested in maybe house hacking, which I absolutely love this strategy. You're going to find a property that's a duplex, triplex, fourplex, and you're going to occupy one of the units as that being your primary residence. The other units are going to have income that, yes, Alex, they will be able to offset. We'll be able to use 75% of the gross rents of the other units to offset the mortgage payment. So from a debt to income ratio, that's going to be a benefit. But on an owner occupied, you've got much higher leverage. So you're not bound by 20, 25% down anymore. You could be looking at 5% down or 3.5% down. Maybe we're going to look at FHA. I'm not as up to date on the USDA guidelines about rental income. I feel like you should be able to use it, but USDA is unique because in a rural area, you can get 100% leverage, right? 0% down. So if that were part of where you are in the world, and that might be something that you could find a 2 to 4 unit in that kind of demographic, that could be an option too, 0 down. Maybe you want to move to a place where there's not a lot of hustle bustle and traffic and you want to be out in the sticks and you can find a duplex out there and get a USDA loan for 0 down. Half the unit is going to, or half the property is going to have cash flow. Yeah, anyway, good question, Alex. Thank you for asking it.
I'm just laughing that you're describing USDA properties in the sticks.
Did I say sticks?
Yeah, you did.
Well, they're a little sticks. I mean, that's not a bad thing. Why does that have to be a bad thing? It could actually, for me, it might be a good thing. I'm constantly thinking I want to get out. And
I will say this, and I think it's so Caeli, I don't know if you want to speak to the recent guidelines. I only laugh because I live in South Jersey. And so when I first moved to South Jersey, which was the beginning of 2000, it was literally the sticks outside of Philadelphia. Like if you drove 15 minutes outside of Philly, you were looking at cows. Like it was literally cows. So what's remarkable about that is there's a ton of properties eligible for USDA. So, I would always say it does not have to be in the middle of nowhere. You can actually find properties. And Charles actually says USDA here is very surprising where they have available properties. And I agree with you, Charles. So,
and there's urban growth boundary, right? Where they want to start extending out so that there's more population there. Larry, maybe we should put, there's a map, you guys, that you can type in an address or maybe a zip code.
I'll bring it up on the chat.
And it'll tell you exactly where USDA financing would be applicable. Now, there's income limits too. If you make too much money, you're not going to be able to qualify. But anyway, that's another conversation. What else? Any other questions right now?
So the other thing I was going to ask you to speak to, Caeli, and continuing this line with when you mentioned USDA and other properties on the multi-unit, does it have to be? Is it a problem if you have another property, right, and you're thinking about moving into a multi-unit to try to generate cash flow? Like, can you speak to that? Like, that might be holding some people back as well.
Yeah, that's a good question. So guys, tell me if I'm wrong, Larry. So what he's talking about is called a departure residence. So you own your home, your single family residence right now, and you're going to be moving into a new primary residence and utilize an FHA or a USDA or a 5% down Fannie Freddie conventional, whatever, and you want to do it to purchase a 2 to 4 unit. right? Where you've got a rental and your primary residence kind of all in one fell swoop. The property that you are leaving, if you're not going to sell it, right? Chances are, or maybe you'll sell it because you need the proceeds for your down payment on the new property. If not, if you're going to keep it or retain it, it's called a departure residence, in which case we can use rental income because you want to keep it for a rental. That's what your objective is. You want to keep this for a rental. You don't want to get rid of it. We can give you rents on the departure residence, up to 75% of those as well. Was that the question, Larry?
That is correct, right?
Okay.
So it's really, it comes off if I want to move, but I can't necessarily qualify for the new property while also worrying about the property I'm leaving, but I don't want to sell it because it's a great investment. You know, how do I figure that part out? That's what you answered.
Yeah, so you can use the income from both the other units of the 2 to 4 unit purchase and the property you're leaving. You can give that 75% of the gross rents as well.
And to further the point, again, for those that are near or close to or living in southern New Jersey, I'm putting a map up in the chat, and that little push pin is where I live. Burlington County in New Jersey is the largest county in New Jersey. There's a ton of high value properties in USDA. So just to kind of close that USDA loop in the conversation.
So guys, anybody else out there, what are I want to hear if anybody is feeling brave. I mean, I know some people don't want to kind of get into the mix, but anybody here that's ambivalent about taking the next steps? I recognize a lot of names here. Most of you are active or consistently active and getting out there, and you've breached the barrier of the unknown, and you kind of got your sea legs. So you're doing stuff all the time. But anybody that's kind of that analysis paralysis, it's a real thing. Okay, I sometimes even still get stuck on it. But anybody that is waiting on the sidelines for what is the fear? Let's talk about some of those things and how do you address, or how are you going to get over it, right? You've got all the intentions of the world to be a real estate investor, but you just can't find your way into that first or second step. I want to hear from you guys. Anybody want to share?
So we do have a question from Ron, and it speaks to, you know, good choices, trying to make life choices here. I'll read it. It'll take me a minute to get this all out. So Caeli, costs, right? What is a new mortgage cost in terms of applying and everything else involved? And the follow-up to that is, I'm going to read it verbatim because it comes off really well, Ron. So thanks. So this is from Ron. And so Ron's looking to really grow his rental portfolio, but how do you know whether it's better to do a portfolio loan or just pick an owner-occupied property like onesie, twosie to refinance and then stagger it out as you go? His spouse still has W-2, and as they grow older, they're trying to figure out how to diversify between long and short-term rentals. You know, so there's a lot going on here, and then ultimately they do want to pass along the property to his 3 sons over the next 15 plus years. So it's not only just for the current thing, but it sounds like Ron's also looking longer term, Caeli. So maybe that's a lot to do and a lot to figure out. For sure.
And the answer, Ron, great questions. The answer is you got to take the first step. Right? You're going to have to force yourself to take that first step. And for us, that's going to be to apply. Okay. Not trying to beat a dead horse, but let's unpack these one at a time. So entry costs, that's going to depend, right? If we're doing an owner occupied or a non-owner occupied first. So if capital is scarce right now, then maybe you want to look at an owner occupied first, because you're going to get much higher leverage where you're putting 5% down or 3.5% down. We just went over all of that. Otherwise, if it's an investment property, you're looking at, 20, 25% down. There's actually conventionally a 15% down option. It's Freddie that allows 15% down. However, today at 1:55 Pacific time on the 21st of March, the 85% option comes with such deep discount points to get the rate that it diffuses the whole purpose of getting the extra leverage. So as of right now, this minute, the 85% LTV is not going to be an option because you're paying more points than it would be to just put 20% down. But it will be again, I promise you that. So let's say you've got the 20% down, okay? Then you probably want to look at the lower price point, right? If you know that capital is going to be tight, you're not going to be looking at $500,000 rentals, or even 250. Maybe you want to look at $80,000 rentals in parts of Alabama, or I mean, they're out there, okay? You're probably not going to find those on the coasts of the US, but internally, Midwest, there's going to be states that have those smaller price point properties. So that would be the first thing in terms of cost or entry to cost. Closing costs, this is going to vary too, depending on the geographic area. Property taxes in Texas, for example, are much, much higher than they're going to be in Alabama. So you're going to have to kind of contend with that. Closing costs themselves, it could be 2, 3, 5% of the purchase price is what you can kind of generally gauge. So take the purchase price, very conservatively, maybe use 5% as the threshold for what the closing costs are going to be. And then what you can do, and we're in a great environment to do this, guys, negotiate with the seller to pay up to 2% back, contribute 2% towards your closing costs. I can get into more of that if anybody wants me to, because there's a whole trick to maximizing. If the seller won't automatically contribute 2%, that's the max allowed for investment property. If they will, great. If they won't, there are tricks in which you can kind of finance in seller paid closing costs. I'll come back to that later. Your next question was
before we move on,
yeah.
I did want to throw out there, because Ron added he has a lot of equity in some rentals, and how can we strategize for that? I think this is probably the ideal candidate, Caeli, when Ridge Lending Group launched a certified power buyer program, where you can come in and do a strategy session to really flesh all this stuff out directly with you. Is that the best way, Caeli?
100%, Ron, because it's very, right now, guys, everything I'm going to give you is going to be kind of subjective, right? Based on all these variables that may or may not apply to you. If you want to get real customized and subjective, Ron, that'll be one-on-one with me. So yes, certified power buyer, you got to apply, get your vials of blood in there, and then we can peel back the layers and come up with that plan.
Okay.
Yeah.
Sharon asked a question. The fear that Sharon has is expanding to the next one. Sharon's got one townhome rental income. Sharon's concerned that they won't be able to expand to the next one just because they feel so contained. Any response to that?
So Sharon, when you say I feel contained, is that because the cash flow is not really there yet? You're feeling like you've bitten off more than you can chew with this one, and that to get into another one, you feel like you've extended? Is it qualifying, or is it reality?
We'll wait for an answer on that.
Yeah.
So Sharon, that's back to you. Thank you, Caeli. Denise asks a question about the all-in-one cash out. Oh, we got an answer right away. So, okay. So the question really is qualifying. So Sharon feels like that only because there's only Sharon only has one property. Like somehow that's going to be a negative.
If Sharon, if you're meaning that the only income that you have is coming from that one rental, that's the only source of income you have, a couple things that I would say. One, we have other products that won't make any difference. Okay, so yes, so the only income that Sharon has is from this one rental property, and chances are this rental property has a mortgage on it. It's got taxes and insurance, whatever. So the net cash flow that we would be able to use from her is probably going to be a small-ish number. Maybe it's 100, maybe it's 1,000. I don't know the property or any of those things. But here's two things I would say to that, Sharon. One, the amount of income that we can show is a lot less relevant in qualifying conventionally than it is the amount of income in relation to your monthly liabilities on your credit report. So if your credit report shows that your monthly liabilities is $30 a month on a credit card and that's it, your income technically to support that only needs to be twice that amount. So just keep in mind that the income is a lot less important, gang, than it is in relation to the monthly debt that I'm going to see on your credit report. That's the key. And if that doesn't work, guess what? We have other products. We're going to go debt service coverage ratio. So your income, Sharon, is no longer even relevant. We're going to look at the property that you're looking to purchase and the gross rents of that property, either by a lease if it's currently tenant occupied, or the appraisal, which will give us a median of what the rents for such like-kind properties are currently. And we're going to take that number and divide it by the proposed principal, interest, tax, and insurance, and HOA if it's applicable. And as long as it gives us a 0.75 or greater, that property qualifies debt service ratio. Now, just to kind of give you the math real quickly, a debt service coverage ratio is simply gross rents divided by the PITI, principal, interest, taxes, insurance, and HOA if it applies. If the gross rents are $1,000 a month and the PITI is $1,000 a month, your debt service coverage ratio is 1.0. The minimum it can be to qualify for that product is 0.75. So if the gross rents were 750 and the total payment was 1,000, that qualifies for debt service. So Sharon, sorry, if we can't get you to qualify full doc today, then we move on to the debt service coverage ratio products. And over time, once you've amassed enough of those, chances are, per the Schedule E, we'll be able to help coach you on this. You may have enough income to show via your tax return, via your rental properties, via your Schedule E, to then go full doc and maybe more of a conventional way. Might take some time, but you'd get there.
Sharon's like, wow, thanks for the help. And this is what we're here for, guys. This is exactly, Caeli, that we're looking for, try to help folks and talk about things that you thought were holding you back.
Yeah.
So Denise asked a question that really gets at the heart of some of this too, where again, people are afraid because maybe their property is currently in an LLC, Caeli, and they're afraid to like take it out just to get financing. Is that a requirement?
It is, if you, depending on the product that you want. So if it's currently held in an LLC and you're ambivalent about pulling it out to get conventional financing or all-in-one non-QM, you can keep it in the LLC name. That's fine. The loan is still going to be in your individual name. But if the LLC is for asset protection, right, that's really what it's for, then the loan being in your individual name has no bearing. One doesn't know about the other. There's not going to be any problem with that. But I would want to have a further conversation, Denise, to find out the fear of pulling it out of the LLC. I mean, I understand the break in chain of title for that period of time, and then it starts over again. But guys, in the event that you're sued, and maybe we end on this, Larry, because I've got another speaking thing at 2:10. Let's say that you've got a tenant that's litigious and they're going to come after you. Okay. First of all, their attorney is going to have to do a title search, right? And find what assets, find you as an individual just by yourself. You're going to have insurance on the property, so chances are that would cover it anyway. But in order for them to find you individually, the individual, and let's just say that you live out of the state of where the property is, the attorney is going to do a title search, okay? And they're probably going to go back at least 24 months in time, usually, maybe more, but generally about 24 months in time. Because otherwise, I mean, the data and the amount of time it takes is exorbitant. But they're going to check back 24 months and they're going to have to look in order to find you, especially if you're out of state of where the property is. They're going to have to scrub every single county in every single city in every single state of the United States to find your name, to then identify if that, if there's any ownership there. Maybe some more one-on-one offline with that question, Denise. I think that the risk and the fear may not be equitable. I think there's probably more fear than there is risk there, especially if you've got the appropriate insurance.
Awesome. So for everyone here, I put in the chat, the toll-free number for Ridge Lending is 855-74-RIDGE. You can call, you can set up a time with Caeli or any one of the dedicated lending specialists. If you'd rather email, you can do that to info@ridgelendinggroup.com. If you'd rather just do an application and get everything over and have Caeli or one of the dedicated lending specialists call you back with some information, you can do that at ridgelendinggroup.com as well. And Caeli, we want to thank you very much always for your limitless knowledge and experience.
Thank you.
And want to encourage everyone who's listening to this replay and everyone who came here today, please come back every Tuesday at 4:30 p.m. Eastern, and we'll keep this conversation going each week.
Thanks, guys. See you next week.